Okay, this is the number one question that my clients ask me on a regular basis. Riggs, do I qualify for a loan? So here's the general guidelines. First, you need to have a 2-year work history, preferably in the same line of work. You also need to have at least a mail credit score of 620. Now, if you don't know what your score is and would like to find out, just call or email me. We would need a 2-year verification of rent, and this is done a couple of ways. A verification of rent signed by the apartment management company or real estate management company, or your last 12 months canceled rental checks. Now, sometimes you may have been staying at your folks' house or in a situation where you have been paying rent for the last couple of years. This is called payment shock because you would be facing a future mortgage payment that you haven't been paying before. Compare that to a situation where you have been paying rent for, say, $1,200 a month, and your new mortgage payment would also be $1,200 or less. In this instance, there's no payment shock and would be considered favorable. However, a payment shock would be a concern for the underwriter, but this could be compensated by 3 factors. You need to have low ratios, at least 2 months reserves, and a good clean credit. What are ratios and reserves? Ratios could be understood by the following formula. Your new mortgage payment plus car payment, if any, plus your minimum payment on credit cards or student loans, if you have any, divided by your average gross monthly income. This number should be less than 0.41 or 41%. The lower you are on this number, the better. If you're slightly over, it's okay, just as long as we have compensating factors like reserves. What are reserves? After you pay your down payment and closing costs, the underwriter would be looking for at least 2 months mortgage payments or reserves left from your account. Of course, the more money you have left over, the better. The mortgage payment would include principal, interest, taxes, insurance, and association fee if that applies. Last, you need to have a good clean credit where you have no foreclosures, no bankruptcies, no collections. If you had a bankruptcy or foreclosure, there are set time limits on when you could start purchasing a house again, and that's covered in another video. If you have collections, we would need to look at what kind of collections you have, medical, autos, utility companies, etc., and how much the collections are that are outstanding. So this is generally how we would look at your file and see if you can qualify for a loan. I say generally because, to be honest, each loan applicant and their situation is unique. One of the first things I looked at is the credit report. This is where I find out potential concerns, if there are any. Next, I look at the employment history and bank accounts. On the employment history, I'd be looking for gaps in employment. And on bank accounts, I'd be looking at NSFs, or non-sufficient funds, where the balances become less than zero. These are all underwriter concerns, and it needs to be addressed and explained. Now, this may be a bit overwhelming for you, so the best thing to do is just call or email me so we could look at your particular situation. Thank you.